Hey, everybody. Welcome back to another episode of the Work Hard, Invest Harder podcast. I am your host, Justin Dixon. And today I've got Brandon Hall on the podcast. He is a tax professional. He's got his own CPA firm where he works with real estate professionals, real estate investors, how to, benefit or take advantage of the tax strategies that are available for real estate investors to offset some of their taxable income and really keep as much of the profits as they possibly can. So we dig into some technical things, but we keep it super high level so everybody can kind of take some nuggets away from this episode. So let's welcome Brandon to the pod.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, Brandon. Hey, man, welcome to the pod. Happy to have you on, man.
Thanks for having me on, Justin. I'm excited for it.
Awesome. Well, let's kick things off here. Why don't you give a quick intro to the audience, kind of who you are, what you're up to, any real estate stuff you're doing, and then we'll kind of dig into some stuff.
Sure. Yeah. So my name is Brandon. I run a remote CPA firm. So all of our employees work out of their homes. I'm in Raleigh, North Carolina. I started my firm back in 2016. We've grown it to 42 US employees and 20 employees offshore between the Philippines and India. And we provide tax planning services, strategic planning services, compliance, like preparation services, and outsourced accounting services to around 800 clients across the United States. And the unique thing about our firm is that every client is investing in real estate in some capacity. So we've got clients that are at the beginning of their journey. They're buying their first long-term or short-term rental. We also have clients that are at the end of their journey and they have 9-figure portfolios. And it's a lot of fun to help them kind of really think through everything and pull some tax savings out of that portfolio. So that's kind of what we do on an ongoing basis. We are very, very big on the content production. So we've got a podcast, we have a blog, we have a big Facebook group that a ton of investors are in, and we give a lot away for free, which kind of gets people into our ecosystem and learning about who we are. And eventually, hopefully, the idea is that as they grow their portfolios, they say, this is getting too complicated. Let's just go get Brandon's team to help us out. And that's primarily been our growth model to date. And it's worked really, really well. But on the personal side, I have 25 units between multifamily, single family. I've got a short-term rental at the beach, got a single family rental, I've got a triplex, and then I have 10 duplexes and probably something else that I was missing in there. But yeah, love real estate, love the wealth creation that it can provide. I love the compounding of not having to pay tax on the profits and just being able to roll that right back into the next property. And seeing our clients too, at various stages of their journey made me realize real estate is absolutely a wealth building vehicle if you can get that compound machine working in your favor.
Got it. So you started the firm in 2016, I guess. When did you start kind of your real estate investing journey?
I bought my first 3-unit property in 2015, at the beginning of 2015. Okay. And I still have it today. I bought it for like $90,000 and now it's worth like $300,000, which is crazy. Awesome. Yeah, I bought it in like a tertiary market too. I remember going into it as like, I'm going to buy this for cash flow because this market will never appreciate. It was my hometown, Hickory, North Carolina. Yeah. Okay. Now it's worth like $300K. I was like, what in the world?
Yeah.
Well,
you're
so
kind of up in the, in what do they call it? The triangle up in Raleigh, Durham, Winston-Salem and Charlotte, right? Those are kind of the triangle in North Carolina. So
yeah. And Raleigh's like blowing up too. Yeah. So like we've had very similar experiences with our Raleigh properties where, you buy it and you're like, all right, it's a little expensive. The cash flow is not as great. And then the appreciation's just been swelling over the past few years. And it doesn't seem to be slowing down. It doesn't seem to be slowing down because there's no inventory. And that's the thing. Like everybody's all like, oh, there's going to be a crash and stuff. And I don't think there is because there's just no inventory. Their demand has stabilized a little bit because, rates have gone way up. So purchase applications are way down, but like there's just nothing to buy. So so you're still getting into bidding wars. You're still seeing prices increase, but we can table that, I guess, for another part of the conversation.
No, it's interesting. I actually visited Raleigh, or I stopped in Raleigh on a fact-finding trip back in 2020 when I started kind of the multifamily journey, and I stayed overnight in Raleigh. I cannot remember where it was, but it's like, it was a hip little downtown that didn't exist like 2 years ago, right? Like it was just like this multi-unit, shopping centers, bars, restaurants, and it just kind of popped up out of nowhere, which was super fascinating. But so taxes is not typically a sexy topic, right? No. When you think about it as like a normal W-2 employee, it's kind of something that you have to do every year, but when you kind of start getting into the investing world, especially in real estate, it can be fun in the sense that there's all these strategies. And that's one of the reasons why I wanted to have you on, was because there's things that the layperson doesn't know they can do legally, right? But so let's kind of start to unpack this, and maybe we'll start the conversation with somebody that, they are listening to this podcast. They want to start their real estate investing journey. They're, mid six-figure W-2 employee, kind of the normal kind of passive investor, and they want to kind of start their journey. Like what are some of the things that they should be thinking about kind of, in preparation for, getting that first investment, whether it's a short-term rental that they want to get into, or, like a multifamily syndication as a purely passive investor?
Yeah. So I think the first thing to cover is just to understand how taxes play a role with real estate investing and just in general, right? Yeah. So if I'm a W-2 employee and I'm six figures, if you're listening to this podcast, you've probably gone through like the FIRE movement. You're trying to become financially independent. All of our clients are trying to become financially independent. So that's who I'm going to kind of speak to, right? So we've done all this work, all this research, all this knowledge building to understand what to invest in. But the interesting thing is we also spend all this time thinking about how to budget, and we track all of our expenses, right? And so we cut out the Starbucks coffee. That's a classic example. We reduce our monthly meals that we're going to go out and have, the monthly dinner and date nights and all that type of stuff, right? So we do all this work to try to reduce our expenses, but we never spend any time thinking about our taxes. Yet the taxes are the biggest hit. Your taxes are your number one budget item. It's bigger than your mortgage in most cases. It's your most expensive piece of the entire puzzle. And you can look at your marginal tax rate and say, well, I make $100,000 and I paid $20K in taxes, so it's actually not my biggest expense. But you might also be not factoring in the employee side of Social Security and Medicare taxes as well. It's like you pay a ton of taxes. And I think the first step is just recognizing you pay a ton of taxes. Typically what happens is once people recognize they pay a ton in taxes, they get a little sick to their stomach and they start going, how do I not pay this much in taxes? Right. And they'll do some research and meander their way into the real estate world. Because in real estate, I can buy rental properties, and if I can structure my situation correctly, when I buy a rental property, I can also offset my W-2 income. So I get the best of both worlds, right? I bought this asset and I'm also reducing my W-2 income and the amount that's taxable on the W-2 side, which means I'm going to get a big refund at the end of the year because my W-2 is paying in taxes every single month. But even if you can't do that, if I buy rental real estate, I can create cash flow streams that I don't pay tax on today. And the reason that I don't pay tax on those cash flow streams today is because of depreciation. So when I buy a $200,000 single family home and I go and rent it for $2,000 a month, my gross rents at the end of the year are going to be $24K. My expenses might be $10K. So my net operating income is going to be $14,000, meaning that I made $14,000. Yep. But like I could do some things with depreciation to maybe make depreciation like $18,000 in the first year. So even though I made $14,000 and that was $14,000 that actually hit my pocket, or some of it went to pay off some loans or whatever. But regardless, I made $14K. I get to tell the IRS that I actually lost $4,000 thanks to this $18,000 depreciation deduction. So in effect, I made $14K tax free, or at least tax deferred. I didn't pay tax on it today. I will pay tax on it at some future point, which we don't have to get into. But today I've got $14K that I didn't pay tax on. And so if I'm making $100K at my day job and I've got $20,000 in taxes from my day job, and then I go and I add this rental property and I make $14K and I don't pay tax on it, well, now it's really happening in my overall tax situation. I'm making $114K in income. but I'm still only paying 20K in taxes.
Right.
So my effective tax rate has decreased. And this is the Warren Buffett approach to investing. So Warren Buffett, the whole thing is he pays less in taxes than his secretary, right?
Yeah.
Which is not true. He pays more dollars in taxes than his secretary, but his effective tax rate
percentage wise. Yeah.
Yes. Yeah. So total tax to total income, that ratio is lower. And I think once people realize this, they start buying they buy one property, then they buy two, then they buy three. And think about that. If you can 10x that, it's $140,000 that you're going to make and not pay tax on today. That's the same. It's effectively the same thing as like making $200,000 in W-2 earnings, right? So you get this compounding that just accelerates your wealth building and allows you to really scale it all up. But it's depreciation. It's really understanding that I can shelter the cash flow on an ongoing basis thanks to depreciation. And in markets that run up, right? So my 3-unit that I was talking about, I bought it for 90, now it's 300K. Well, I can get the compounding on the equity as well, because when I sell that property, like let's say for whatever reason, the cash flow isn't where I want it to be on a $300,000 property. I sell the property, but I can 1031 exchange it. It's like Monopoly, where you have the 4 greenhouses and you trade it for one big hotel. Right. Same thing. You're not going to have a taxable down the road. Exactly. I'm just kicking it because I'm taking the gain and I'm just rolling it forward into the next property. So I don't pay taxes today. So the point is that real estate is a super tax efficient way to not only get current cash flow, but to build wealth through appreciation, equity build, really never have to pay taxes on it. I mean, if you structure it right and you just swap, we call it swap until you drop. You 1031, you 1031, you 1031, then you die. When you die, your heirs get the property. They get a stepped up basis in the property. So they wipe out all the gains, all the depreciation that you've previously claimed. They get to start the process all over. You can do that. And throughout the way, some people might be like, well, I need to use that money. Well, the beautiful thing about real estate is you can take a cash out refinance, right?
Loan against it and all that. Yeah.
100%. And you don't have to pay tax. That's not a taxable transaction, right? So real estate's just super, super powerful from a tax optimization perspective, which is why we built an entire firm around advising clients on it.
Yeah, no, super interesting. There's a couple things I want to dig into, but we're going to take a quick sponsor break, so we will be right back.
Whether you're in a job you love or hate, building a financial foundation is important. This foundation can support you by providing passive income, stability in an uncertain economy, or the launching pad for you to start your own business. Great Venture Capital helps busy professionals invest in commercial real estate to build passive income streams, grow wealth, and take advantage of tax benefits. If you'd like to learn more, check us out at greatventurecapital.com or send an email to justin@greatventurecapital.com.
All right, we are back on the Work Hard, Invest Harder podcast with Brandon Hall. So we kind of were talking about kind of a tax strategy, tax scenarios, and you mentioned something about being able to offset your active income, your W-2 income with real estate. So maybe can we take that one example or one instance and kind of unpack that a little bit? Because I feel like if you're a W-2 employee, and to your point, if you're making $100,000, you're paying $20,000 in taxes. But if I can invest in real estate and somehow offset some of that, how does that work?
Yep. Love it. So everything I just described, that's like level 1, right? Just understanding that real estate is tax efficient naturally. The next level is understanding that you can pull certain strings and make it, you can turbocharge the tax savings. So when I buy,
right? This is all legal. This is not.
All legal. Yeah. This is black and white. I think what you'll find is if you use an accountant that does not have a lot of real estate clients, they will get confused with this stuff. But this is all in Section 469 of the Internal Revenue Code. Section 469 describes the passive activity loss rules and basically helps you understand what type of an activity is passive and how to make that activity non-passive. So in 1986, Congress implemented the passive activity loss rules. Before 1986, I could be making $1 million as a doctor. I could go buy a bunch of real estate. I could use the depreciation to create big tax losses, and I could use those tax losses to offset my doctor income. No ifs, ands, or buts about it. But 1986 rolls around and Congress says, hey, it's not fair that Rich people are using rental real estate as a tax shelter. So we're going to implement these new rules that prevents that. And basically what happened was they moved rental real estate into this, I refer to it as two buckets of income. Okay. They moved rental real estate into the passive bucket of income. And then everything else is in my non-passive bucket of income. So my W-2 job, my business income, my capital gains from stock sales. I know that sounds weird, but that's in the non-passive bucket. Interest income is in the non-passive bucket, dividends in the non-passive. Basically, it's just a way to like put real estate on its own island. And then what they said is any losses created from passive activities, you can offset income from passive activities, but any excess losses from passive activities, they're just going to be suspended and carried forward. You cannot use those excess losses to offset your W-2 income and your business income. So that's what the rules say. Now, in 1994, they added something called real estate professional status. So real estate professional status, if you can qualify as a real estate professional, and if you can materially participate in your rental activities, then you effectively move the rentals out of the passive bucket and you put them into the non-passive bucket. And so now if my rentals generate a tax loss, after we factor in like depreciation expenses, then I can use those tax losses to offset my W-2 income. And so if you think about the power of this, if I buy a $1 million multifamily property and I've got a $400K W-2 job and my wife maybe qualifies as a real estate professional on the multifamily property, then we cost segregate it, we bonus depreciate it. I might get a $200,000 tax loss coming out of that multifamily property that I could then use to write down my $400K of W-2 income. But the key is that my spouse qualifies as a real estate professional and materially participates in the $1 million rental property. So it's really powerful if you can get it, because now I'm getting a refund from the IRS that I can roll into the next property. And again, it increases the speed of that compounding that I was talking about. And there's some other ways to get around the passive activity loss rules, but qualifying as a real estate professional is the main one. So if you qualify, you can start writing off real estate against your W-2 income.
So let's define a couple of those terms if people aren't familiar. So what does it mean to qualify as a real estate professional, right? Because it's a time allotment, right? Like it's amount of hours that you have to prove to the IRS. And this is not something you can just be like, yep, I did it. Trust me, right? You have to actually document the hours and the activities and the calls and the trips and all that stuff. So what is it? I think it's 750 hours a year. Is that right?
Yes.
That you have to actively be participating in real estate activities. That can be, that can be underwriting deals. It can be doing investor relations, raising anything that's like actively involved in real estate. And correct me if I'm wrong, if I'm stating it incorrectly, but.
No, you're on it. So it's 750 hours during the year and more time in real estate than anywhere else. Okay. So if I have a full-time W-2 job, I would have to prove to the IRS that I spent an additional 2,081 hours in real estate. So I spent 2,080 hours in my job and then another 2,081 hours. And the IRS is never going to buy that you worked 4,100 hours with no breaks. That's like 13-hour days or something like that every day, no holiday, no vacation, no sick days. And if you don't like what the IRS says, the tax court's never going to buy it either. People have tried and they lose in tax court. And I'm also an optimist. I think somebody one day will win, but we haven't seen it yet. So if you have a full-time job, you can't qualify as a real estate professional, but your spouse could qualify as a real estate professional. If your spouse doesn't have a full-time job, maybe they have a part-time job, maybe they stay at home with the kids. They can qualify as a real estate professional. And when you file a joint tax return, you will have a real estate professional status tax return. That's the way I kind of like to think about it. So in my example, where I've got the 400K W-2, we go buy the $1 million apartment complex. My wife qualifies as a real estate professional. And now we can use that $1 million apartment complex to our advantage in writing off my W-2 income. And the hours that count, because you kind of brought that up, it's really going to be running the deal. So it's not going to be like education and research hours. Like listening to this podcast is not going to count as real estate professional status time. Investor level hours, such as coordinating with my brokers, my mortgage broker, my agent, my attorneys at closing, none of that time is going to count unless I'm the one running the property on a day-to-day basis post-close. And the reason for that is any investor would do that thing, right? Any investor would do that due diligence, and that doesn't separate you from a real estate professional who's actually operating and running the deal on a day-to-day basis. on an ongoing basis. So it's really important just to, like, the way that I like to think about it is if you were to hire a property manager, they are the real estate professional. So like whatever they're going to do, that's the time that's going to count for real estate professional status.
Got it. A couple of the terms you mentioned, and this may be kind of level 2, 3 for some of the listeners, but cost segregation and bonus depreciation. And I know the bonus depreciation rules changed, I think, this year, right? So maybe talk through maybe those two items.
Yeah. So bonus depreciation allows you, well, let me back up. Cost segregation studies allow you to accelerate recognition of depreciation. And what I mean by that is, let's go back to my $1 million apartment complex that I bought. I buy $1 million apartment complex and I have to figure out how much of that value is attributed to land, because land cannot be depreciated. Land does not fall apart over time. It's just dirt. So maybe $850K of my $1 million is building and the other $150K is land. Well, normally I would just take the $850,000 of building value, divide it by 27 and a half years, and that becomes my annual depreciation expense, whatever that number is. Why is it 27 and a half years? I don't know. That's just what Congress set up. So it's 27 and a half years. Now, a cost segregation study is basically the practice of saying, hey, in that $850,000 of building value, there are a lot of components that are not going to last 27 and a half years. These components will last 5 years, 7 years, or 15 years. Again, schedules made up by Congress. So those are the buckets that we have to work with.
Right.
But the cost seg study will basically pull value out of that 27 and a half year class life, pull some of that $850,000 away, and it'll assign it to 5, 7, and 15 year class life. Carpet, for example, is going to be depreciated over 5 years, not 27 and a half years.
Right.
So that's what a cost segregation study is doing. It's basically saying we recognize that there's a lot of components that are going to wear out a lot faster than the overall building. It's going to be a lot faster than 27 and a half years. Now, what that allows me to do, let's say that I pull out $10,000 of carpet. So I was going to depreciate $10,000 over 27 and a half years, which would be like $250 a month, a year or something like that. But if I do a cost seg study, I could depreciate this $10,000 over 5 years. And you depreciate it using double declining balance. And I'm not going to explain what that is. So to keep it really simple, it's just do $10,000 divided by 5. Now I've got $2,000 a year of depreciation versus $250. Right. Again, for 5 years. After 5 years, I've fully depreciated the carpet. So now I have zero depreciation from the carpet. But that's not a bad thing because I've front loaded all my tax benefits, right? With inflation raging the way that it is today, that's what we want to do.
Yeah.
So that's kind of what a cost seg study does. Now, bonus depreciation says any component with a useful life of less than 20 years qualifies for bonus depreciation. All right. So what I just said was cost segregation studies say, let's take value out of the 27 and a half year class life and assign it to 5, 7, and 15 year class lives, all of which are less than 20 years. So all of which qualify for bonus depreciation. Right. In 2023, you can bonus depreciate 80% of that value immediately. Last year, 2022 was 100%. Next year, it's going to be 60%. It's going to continue dropping 20% until it reaches zero, I believe, in 2027. So if we pull out $100,000 of value from my 27 and a half year property and we assign it to 5, 7, 15 year property, I can, using bonus depreciation, immediately write off $80,000 of that value. So on my tax returns, all of a sudden, this results in a very large tax deduction, which results in a very large tax loss, which allows me to really quickly write my income down and get a big refund from the IRS. That is essentially what's happening. And that's what everybody is focused on in real estate.
And so what happens when, in whatever year you said, when it goes away, you're just able to use the normal numbers, the normal depreciation numbers, not any kind of multiplier or bonus?
Correct. Yeah. So you would just use that cost segregation study. The carpet would be depreciated $2,000 a year for 5 years, rather than $8,000 in year one, if that makes sense. I do want to caveat this real quick because there are CPAs that listen to this and they like to go online and say, nobody ever talks about depreciation recapture. When you depreciate a building, like I buy a property for 100,000, I depreciated 100K. Or sorry, I buy it for $1 million, I depreciated 100K. The cost basis is now 900K. The adjusted basis is now 900K. If I sell the building for for $1.1 million. My gain is not 1.1 million minus what I bought it for, $1 million. My gain is 1.1 million minus my adjusted basis. So it's 1.1 million minus 900K since I depreciate it. So my gain's actually $200,000. 100K of which comes from depreciation, right? It's gain from the depreciation that I took. That's called depreciation recapture. And when you accelerate depreciation, bonus depreciation, you can recapture that at ordinary tax rates, so up to 37%. So you've got to be careful. It's not as, it's not as doom and gloom as I think some professionals make it out to be. At least not in our experience. I'm sure that they've seen experiences where it is doom and gloom.
Right.
But in our experience, most investors will 1031 exchange it and just continuously kick that can down the road and not have a taxable event where they actually have to recognize that depreciation recapture. But I did just want to caveat that, like, bonus depreciation is amazing, but it is effectively a loan from the IRS. At some point, you will have to pay it back.
Got it. Well, it's a good transition, actually, because I was curious to kind of dig into the 1031 exchange thing. And I guess I've not done it. I've heard a lot of other investors do it. I guess I'm curious kind of for my own purposes to learn about how much money should be 1031 exchange, right? Is there a target number? I know some of the syndications that I do, we don't bring in any 1031 exchanges that are less than, I think, $250,000 or $300,000, just because it is, additional work from a legal and structural standpoint to bring in a 1031 exchange. So it doesn't make sense to do it with less than that. So, in your example, if you bought $1 million property and, you, I guess, 1031 exchange out of that with only, I guess, $100,000, like, does it make sense to do that? Or how does that work?
Yeah, I think this is a very individual question because everybody values their time differently. I have seen investors who believe in tax savings at all costs. Okay. And so they'll 1031 even if it's like, $30,000 of gain because they're looking at $5,000 or $6,000 in taxes. And I would not do that personally. I would not recommend that because the 1031 exchange process is not simple. It is arduous. It does require your time. It requires a lot of your coordination between various professionals. You've got the 1031 intermediary, you've got your closing attorney, you've got your CPAs, and everybody's like talking and saying different things, and you're the one that has to piece it all together. So it does take a lot of time to pull this off. And then you have the various like deadlines to actually make all this stuff happen.
There's a time limit on how fast you have to transition that money into another deal, right?
Exactly. And I don't want to make this sound like 1031s are not good. 1031s are amazing.
Right.
But I don't know that I would do it to avoid $6,000 in taxes. So for me personally, that tax avoidance threshold is going to be around $15,000. Like if I have $15,000 in taxes resulting from a gain, I'm going to explore 1031 exchange options. And that might be like $60,000 to $70,000 or so $1,000 in actual gain. But even that might be a little too low. It just kind of depends on what you have going on in your life and how much time you really want to dedicate to this. Like, how do you value your time? Yeah.
So let's talk about the timing and, because somebody may be listening to this and they have, a $200,000 gain that they're going to be sitting on because they may want to sell something. So, what's the timing look like? And also, what qualifies as a property that you could then 1031 exchange into?
Yeah, so you can 1031 exchange into pretty much any investment property, right? So you can't. I think the number one thing to understand is that if I am an LP in a syndication, so if I'm in one of the syndications that you guys are running, I have a partnership interest. I do not actually own the underlying real estate,
right?
And because of that, I can't do a 1031 exchange because you can't 1031 exchange partnership interest. You can only 1031 exchange interest in real property, which I do not own when I'm a partner in a partnership. So it's important to understand that when I get cash out of a syndication, I can't 1031 exchange that money. I also cannot sell a property in 1031 exchange into a syndication unless the syndication is structuring it so that I can. And you can structure it so that people can 1031 into the syndication. So that's the number one question we typically get from investors because a lot of people passively invest in different syndications.
Yeah.
But in general, it's just investment property to investment property. So as long as you're selling an investment property and you're going to buy a property that's going to be used for investment purposes, you can do that 1031. So I could sell an apartment complex for a plot of land. I could sell a plot of land for an apartment complex. I could sell an apartment complex for a Walgreens. Like as long as it's investment property, you're good to go. In general. Like it's not like that blanket, but that's pretty close. When you sell your property, you have 45 days to identify replacement properties. And you have to write these down and you have to send them to your intermediaries. They got to log the fact that you identified replacement properties. Then you have 180 days, and this 180 days runs concurrent to the 45 days. So the 180 days starts at day one of closing when you sell. You have 180 days to actually close on one of those properties that you identified. And the properties that you identified, generally speaking, needs to be higher value than the property that you gave up in order to avoid cash or mortgage boot, which is basically just like boot just means extracting value from the 1031 exchange. You have to pay tax on any value that comes out of the 1031 exchange. Now, there's different ways, like you can actually exchange down. So you don't have to exchange up. You don't have to, but you'll have some tax consequences. So like, the general rule is buy something bigger, identify within 45 days, close within 180 days. And you'll be good on the 1031 exchange front. When we see 1031 exchanges work really well is when somebody has picked up the new property, put it under contract, and put their current property under contract as well. So they've got the sell side and the buy side under contract at the same time, and they close relatively close to each other. Got it.
Are there any interesting tax loopholes, or not loopholes, actually, like, I guess, laws or kind of differences with short-term rentals versus like single family, multifamily, passive active? I was talking to somebody and I think they mentioned something about some uniqueness to short-term rentals. So yes. Can you disprove or prove that he was correct?
No. Short-term rentals are amazing. So the passive activity rules that I was talking about, where it creates two buckets of income, passive and non-passive. Yep. Well, all rentals go into that passive bucket. And there's like a couple ways, but the main way to pull it out of the passive bucket and put it into the non-passive bucket is to qualify as a real estate professional and materially participate in the rental properties. Now, the problem with qualifying as a real estate professional is the second test, right? 750 hours is fine. But the second piece of that is I got to spend more time in real estate than I do anywhere else. So if you're working a full-time job, you can't qualify as a real estate professional. Your rentals are forever passive. But a short-term rental is a little bit different. So if the average period of customer use is 7 days or less on a rental property, it is a short-term rental. And what that means in terms of the Internal Revenue Code is that we don't actually have a rental property. I'm doing air quotes right now. So definitions and words are very important when it comes to reading the code and understanding cross-references. But a short-term rental it's not a rental property. And so if you go back to section 469 and you look at the whole real estate professional status exception, it says all rental properties, all rental activities are passive unless you qualify as a real estate professional. But if I don't have a rental activity because my average period of customer use is 7 days or less, then I don't have to qualify as a real estate professional in order to make it non-passive. I do have to materially participate. So I do have to meet one of the 7 material participation tests. The 3 that we see most often are your participation is substantially all the participation, meaning that you did all the work. Nobody else participated in the activity, including, cleaning crews and linens and property managers and maintenance guys. You did all the work. Your participation, substantially all. If you can meet that test, then you are materially participating. The second test is you spend 100 hours in the activity and more than anyone else. So if your cleaning crew spent 108 hours, you have to spend 100 hours and more than them. So you got to spend 109 hours to be materially participating. And then the third test is more of like a safe harbor. If you spend 500 hours in a passive activity, you are materially participating in that passive activity. So if you can meet one of those 3 tests, you basically move a short-term rental out of the passive bucket and put it right into that non-passive bucket. But the key is that those 3 tests do not include working more in real estate than anywhere else. That's the real estate professional status test. And that only applies to, again, rental activities. Right. A short-term rental is not a rental activity. So you can work a full-time job. You can go buy a beach home. You can rent it out on VRBO, Airbnb. You can do the cost seg, you can get a big tax loss, and you can write that tax loss off against your W-2 income.
Got it. Okay. You explained it obviously a little bit better than he did because he's not a tax pro, but that's super interesting because I started to dabble or really look at short-term rentals just to kind of diversify outside of just the multifamily stuff that I'm doing. So that's actually really interesting that's the thing. So just to kind of clarify, so I understand it. So you have to essentially manage the property. You can't buy the thing and then have a property manager manage it, have somebody clean it. You have, because that you would essentially wouldn't have the time qualification to say, I worked 100 hours or I worked more than anybody else in the actual leasing, cleaning operations of the property. Is that right?
Correct. Yeah. You've got to self-manage in the year that you're going to qualify or in the year that you're going to meet one of those material participation tests. If you don't self-manage and you do have a property manager, or sometimes we get clients that have like a condo and they're going to self-manage the condo, but really there's like somebody there at the condominium that lets people in and out and handles day-to-day maintenance requests. You're going to have a really tough time convincing the IRS and the tax court that you are the one that's running the day-to-day operations. Yeah. So that is the caveat. That's the thing that you got to figure out. And that's what we do a lot of our tax planning on when we have clients that are looking at something like this. We're helping them understand what specifically they need to do. And I would say just be really careful. Like hearing this, it's awesome. I think a lot of people like go, wow, this is so great. And they start getting a little bit of FOMO and
tomorrow.
Yeah, exactly. Exactly. This is not a reason to overpay. So don't ever overpay for a property, but you got to really work with an accountant that is going to challenge you to do it right. So what I have seen in this space is that there are a lot of accountants that really just want your business. And so they will sometimes tell you what you want to hear rather than what you need to hear in order to substantiate this and win IRS audits. So when we do the planning, we just assume that you're going to get audited. And so we will stack it all up so that you document it correctly and that all your T's are crossed, all your I's are dotted. And there's a lot of great accountants in the space that do the exact same thing, but we have seen the lack of care related to substantiating this. And we've gotten called in on the audits, and typically it's too late to help at that point. So
Got it. So I kind of like picked your brain on a couple of things. I guess, you work with clients that are in the beginning of their journey, like you said, as well as folks that are near in the middle and at the end of their journey. I guess, what are some other tax planning strategies, things that you kind of want to highlight, whether people are in the middle of their journey and they're like, oh, wow, this is something that my accountant didn't mention to me. Or maybe if they're looking at kind of generational wealth and, they've got kids that they're trying to set up and, there's, I don't want to take 4 hours to do this, but, what are some of the high level things that people that have decent portfolios, they should either check, right? They should either kind of talk to their CPA about and make sure that they're, checking all the boxes and getting all the returns that they possibly can. So yeah, maybe share your kind of maybe top 10 list, top 5 list, whatever things that you can kind of, have people make sure they're looking into.
Yeah, I really have like a top 3 list. So okay. Number 1 is make sure that you have a conversation with your accountant and you understand what business expenses are applicable to real estate investing, so that you know what to track and you're tracking the right things. Yeah. Can you deduct your travel expenses? Can you deduct your home office? Can you deduct your coffees that you have with brokers and other people? And it might be yes for some people, it might be no for others, but it's really important to understand what that looks like for you so that you can keep an eye on your own business expenses and just make sure that you're getting all the deductions that you are entitled to receive. So that's number 1. Number 2 is having a good conversation on how to include your kids. I know that a lot of people love to like say, oh, go pay your kids and you pay them $13,000 and they don't have to work. Like we're more on that's like a lot of work. A lot of people that say, go pay your kids don't actually have kids. I have kids and getting them to do anything is very challenging. But, what you have to start asking is like, can you actually pay them $13,000? Are they actually worth $13,000? They might be in your eyes, but they might not actually be, legitimate in the working world eyes. So you got to get clarity there. But in terms of involving your kids, there's obviously paying your kids, which I always caution people on. Make sure that you really understand how that strategy works. But where we have seen the major mistakes are adding kids to title. So it's a well, I want to gift some of these assets to my kids. I want them to run the property when they're in their teenage years, and I want it to pay for their college.
Yep.
And I want them to have this great asset. There's two problems with it. The first problem is that they inherit your basis in the asset when you gift.
Okay.
So if you gift at the beginning of the asset ownership, it's not that bad. But when you gift 5-7 years later, like if I gifted part of my 3-unit now to my kids, well, my cost basis was 90, but I'm gifting the value at 300. So they basically get zero cost basis. They get zero depreciation shielding. It's very difficult to run all that. So that's like the first major thing. But the second major thing is when you die, not to get morbid, but when you die, your kids inherit your assets at a stepped up basis. So they make all the gain and the depreciation go away and they get to restart the depreciation. But if you've gifted them throughout your life, stakes in the asset, what they've already received as a gift, that does not get stepped up. So that's just been inherited at your basis. So we've seen instances where dad dies and he leaves this $2 million apartment complex to his kids, but really his kids had like 99% ownership. Dad had 1% ownership, and they did all this gifting back in the 1980s. And now the kids have this massive, this asset that's got all this gain built in that they're going to have to pay tax on.
If they sell it, they're going to get all the, tax hits and all that fun stuff. So got it. Okay.
Yeah. And so the third thing is the tangible property regulations. And I'm not going to go into those, but if you own rental real estate, the tangible property regulations will save you more money over time than bonus depreciation, cost segregation studies, the short-term rental loophole. It'll save you more time than all of that. So understanding, especially on large assets, like if you're syndicating deals and you're a sponsor, understanding the 2013 tangible property regs, or at least working with a firm that understands it and has a step in the compliance process to make sure that gets reviewed, will save you a ton of money later on.
Got it. No, that's super helpful. So I guess I want to kind of transition to kind of the final. I've got 3 questions that I ask everybody at the final stages of the podcast. So I'll just run through these. So I guess what's one piece of advice, and this can be about your business starting or real estate, but I guess what's one piece of advice that got you started or helped you along your real estate journey, or maybe your entrepreneurial journey as you started your business?
Understanding the concept of leverage. So I think that a lot of people, when they start businesses, they try to do a lot of things themselves, but you really don't achieve true scale until you learn how to leverage up your time. So for me, from day one, the idea has always been to build a platform where other CPAs can come on and be extremely successful. And so I've always thought about like what has to go into that platform in order to make the platform as a whole run effectively and efficiently and service way more than I ever could individually. And that is leverage. Every time that we onboard another team member, I gain a little bit more leverage.
Right.
So that's like the number one thing that I try to help people understand. Sometimes CPAs will come to me and ask for help, like scaling their practice. And that's what I try to talk about, is just the concept of leverage and how are they leveraging their own time. And I think you'll see, like one easy way to do it is just increase your hourly rate if you bill hourly, but that only goes so far. The market's only willing to bear so much. Right. So eventually that leverage disappears. So it's just understanding leverage and that can help you scale.
Got it. No, it's perfect. I guess what's your favorite real estate or business or tax book that you're into right now?
Favorite business book, and I guess it could really help anybody in real estate as well, is How to Win Friends and Influence People. It's my number one book. I reread it every year.
Yeah.
Just really good practical tips on how to have effective conversations, be a good communicator, be a good leader, build a solid network of people around you, and just sort of be magnetic.
Yeah, no, great book. I've read it at least twice, over the last number of years. So definitely like it. And so if you hit your financial freedom number, meaning you could live an amazing life just off of the passive income from real estate, what would you do?
Well, I'm already there. So I I'm already doing what I'd love to do. I love building businesses. And I think if I sold my firm and I had like ridiculous money, I would still probably go start another business, probably consulting other firm owners. And I would try to scale that. It's just the practice of showing up every day and trying to build and create that really drives me on an ongoing basis. So probably not the sexy answer of, I would go and like tour Italy.
Yeah.
So,
no, it's actually fascinating. I think most of the people that I've had on the podcast, I don't think anybody has said, I'm going to just go lay on a beach and sip Mai Tais for the rest of my life. I think most people have said a similar version of what you just mentioned about, either whether it's still investing in real estate or still like building businesses or connecting with entrepreneurs. So it's a pretty common theme, frankly.
Having too much fun, man. It's way too much fun.
Well, it's like, what's the thing? It's like, if you do something you love and you'll never work a day in your life, I'm sure you feel like you're working, but if you're having fun while you're doing it, it's not as bad as, punching a clock every day. So
100%.
Awesome. Well, Brandon, man, I really appreciate you being on the podcast. If somebody's listening to this episode and they're like, man, I want to get away from H&R Block and find a real estate tax professional CPA, how can they find you? What's the best way to, you mentioned you've got your own podcast, so feel free, please plug and share how people can reach out.
Yeah. No, I appreciate that. We've got 3 ways. So the first way is the podcast. It's called the Tax Smart Investors Podcast. Tax Smart Real Estate Investors Podcast. We do a new episode every Tuesday, and we kind of go into detail on the tax stuff, but in a way that you can understand it in layman's terms. So that's way number 1. Way number 2 is to find our Facebook group. If you go to facebook.com/groups/tax-smart-investors, you will find that group. We've got about 17,000 members in it, and it's basically just an online tax forum. People ask tax questions, we answer them. And then the third way is if you're interested, if you've heard all this stuff and you're like, this is overwhelming, and I'm just interested in having you guys do it all, you can check our firm out at www.therealestatecpa.com.
Awesome. We'll have all that info in the show notes, so people can just click links and not have to write down and fat finger the wrong link. But we'll have all that in there. So, dude, man, really appreciate the time. This is super interesting, and I took away some nuggets myself. So appreciate you being on the podcast.
Thanks, Justin, for having me on. I enjoyed it.
Awesome. Hope everyone took something away from this episode. I've got another one dropping soon, so keep listening. See ya.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast. Your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.